Hello everyone and welcome back to our series on practice management for qualified financial advisors with Amit. As a part of this series, we pick up crucial aspects when it comes to practicing a financial advisory profession. And Amit Bhai here helps us share his valuable insights on how a qualified financial advisor can run their practice more efficiently. Today is an interesting episode where we will pick up certain practical situations that a qualified financial advisor may face through their professional life in their practice. And we'll hear what Amit Bhai has to say in terms of how that qualified financial advisor can come ahead of these situations and tackle these situations with their clients. Amit Bhai, thank you so much and welcome.
My pleasure.
My first question for today for you is a very prominent, common question. I'm sure you must have heard this a lot. So the question is, in 2020, COVID hit the world.
Yeah.
And the markets globally were going down, right? So how can a qualified financial advisor deal in this situation where, let's say, their client comes up to them and tells them that should they stop putting their money into equity mutual fund, jo SIP chalu hota hai, should they stop their SIP?
Okay.
And withdraw their funds and keep it safe. Let's say on the 1st of April, they're asking you this question on 1st of April, March 2020, 1st of April 2020. Or should they continue their SIP or add more money, or what to do? Typically, when there's a global situation happening and there's a lot of panic around you, and if your destination is identified, what should the client do? And when they come up with this panic, how can a qualified financial advisor deal in this situation?
So brilliant question. And there have been many such instances where somebody has gone to the financial advisor with this question. Now, this answer to the question can be broken down into two parts. And you'll see a lot of notes floating around from various players which would talk about how the markets recover after a fall. Right? Now, that analysis is good on one hand. But the other side is the unique situation of that client at that point in time.
Right.
And if somebody does not evaluate both, then while taking advantage of the crash in the market might be a good idea for some it may turn out to be a disaster.
Yeah.
And from that point of view, the qualified financial advisor who is advising based on the personal unique situation of the client has to evaluate the client side equally well. Let's take a few examples of clients who would have gone with this kind of question in April 2020. As we all know, the market had gone down by roughly 40% from the top, and the lockdown was announced. Now, this was a lockdown which was a totally unknown territory for all of us.
Yeah.
The last time such a massive lockdown happened was probably 100 years back.
Yeah.
But this time around, half the world's population was locked down in the homes. Yeah? So it was unknown. What do you do in that situation? The argument from the market side is, when it is uncertainty and you invest, you reap the highest benefit. But if I look at my own cash flow or my own financial situation, will I have my job continuing in that period is the primary question.
Right.
So let's say if there is a shopkeeper who's selling the non-essential goods. Let's say he's selling school uniforms.
Yeah.
Non-essential. Because anyway, there are no schools. Kids are sitting at home, attending their classes. In that case, because the income stops, how can this person continue the SIP?
Right.
Number two, if somebody loses income for whatever reason, is there sufficient liquidity to take care of that lean phase? In the absence of that liquidity, continuing the SIP may not be a great idea. In fact, one may need to withdraw some more because the period of lockdown was also uncertain at that point in time.
Right.
So what if I've got 3 months worth of contingency fund and the lockdown continues for 8 or 9 months?
Yeah.
Who would fund that period, right? So that's a different situation altogether. Having said that, in a double income family, if one of the family members is the second earner of the family and not the primary earner, and the primary earner's income is sufficient to take care of the household expenses, then there could be a case for this person to increase the SIP amount at that point in time and reap the benefit.
Right.
There are a few aggressive investors that I know personally who were advised by their respective financial advisors because they had the wherewithal, both financial and psychological.
Right.
They actually borrowed money and put some at that point in time, a lump sum. And of course, the rest is history, as they say. They reap the benefit. But if I don't do that analysis of the client's side, and if the school uniform seller is asked to borrow money or double the SIP, then in less than 2 months, that person may look asset rich, but liquidity poor.
Right.
And a good qualified financial advisor would never want to see the client in that situation.
Right. Very fair, very truly put. So let's take a case where a client walks into a qualified financial advisor's office and puts up a case of FD for senior citizens, where you get a little bit of extra interest when the FD is open in the name of a senior citizen. And if a client tells the QFA that what if they can open an FD in their parents' name, who are senior citizens, maybe retire, and earn that extra, half a quarter interest. How should the QFA deal with these situations?
So that's an interesting situation, because mathematically, if you see, a person who is 45, 50 years may get X percentage on the fixed deposit, whereas the same person's parent, a senior citizen, would get that 25 basis point or whatever the bank offers extra. Mathematically higher return. Number two, if the younger person is also earning otherwise, could be in a higher tax bracket, whereas the retired person may be earning lower income, and again, because of the age, being senior citizen, the applicable tax rates could be lower.
Right.
Mathematically, this looks like a good deal. But then comes the other angle. The other angle is, if let's say I invest in the name of my parents, actually I have shifted the wealth to their name. Tomorrow, if any legal heir puts a claim on that money without proper documentation, I may end up losing all or some part of that money.
Right.
Do we take these things into consideration? A qualified financial advisor will say, yes, we do take this into consideration, and we have the conversation with the client. Eventually, the client may take a call to still go ahead with that proposition, but with an open eye.
Right. At least they are aware.
They are aware. Second, if somebody says that I don't have any siblings, I'm the only child of my parents, in that case, what is the risk? Okay, the risk could be tomorrow the parent may want to spend that money or give away that to charity, and for some reason the discussion doesn't happen between the parent and the son or parent and the daughter. That could pose a different sort of challenge.
Right.
Sometimes when I see money in my bank, I start feeling that that's my money. And in that case, I'll be constrained to feel that मेरे account में तो पैसा है, but मैं कितना spend करूँ, कितना ना करूँ, I don't know. But somebody else is deciding that this is not your money. Only this much is yours. And the senior person may start feeling uncomfortable. If these things are discussed threadbare, then the client is in an empowered situation.
Right.
And that really matters the most. Anuj, a lot of times people focus on certain tiny matters by forgetting that eventually it's the journey that counts.
Right.
From here to there, what all are the possibilities? Sometimes we are able to consider some, sometimes we are not able to consider some. But that should not strain the relationships within the family. That should not increase stress on the person.
Right. Fair. I mean, if I think of this instance, a client walks into a bank to, let's say, get a home loan to get their dream house, right? And the bank will not let them get a loan without them purchasing an insurance policy from them, right? Or so-called the investment policy or investment product. But the client is hesitant; they are not willing to participate in such a product, and they reach out to their qualified financial advisor. How should a qualified financial advisor deal with this?
This is an interesting one. A lot of times, people have shared this, that the bank insists that this is required,
Right.
and they just randomly throw names like there is an RBI regulation, etc. So the good qualified financial advisor has actually requested their clients to go to the banker and ask for a copy of that particular regulation of RBI,
Yeah.
or at least the reference number. So we'll just check in. We just want to understand, right? And then the truth comes out, right? Now, does it mean that one should not buy insurance cover over the home loan? No, I'm not suggesting that.
Right.
When there is an outstanding loan, the interest payment is a liability, and that liability is funded through the income of the person who's borrowed the money.
Right.
And to that extent, it is always a good idea to cover that risk of loss of life, which would lead to loss of income while the loan would continue.
Correct.
Right? So to that extent, it is not actually in the interest of the bank, but it is also in the interest of the borrower to have a life insurance policy, or it is the interest of the family members of the borrower to have an insurance policy. Now comes the question, what insurance policy should that be? Should it be a term cover, or should it be an investment linked policy? Ideally, if options are available, then I would want a reducing term cover, because my outstanding loan keeps reducing over a period of time.
Correct.
So I don't want a full loan cover. The day something happens to me, the outstanding amount of the loan gets paid.
Right.
I don't want to leave anything out of that loan for my family, because I would have otherwise provided through another insurance policy separately. But in the absence of that reducing term kind of a policy, a flat term or the level term policy as they call it could be a good idea. Linking investment and insurance for this kind of a thing has one major problem. The problem is the return on the investment linked insurance policy most of the times is less than the interest cost on the loan. Why should the client get into a negative carry situation? When the cost of borrowing is higher and the return on investment is lower, not advisable under any circumstances. The second thing is all the investment linked insurance policies will have a higher premium compared to a term plan. So while you are paying EMI, which is an outflow, you are also paying a higher premium, which is an additional outflow. It puts a strain on the cash flow for the family. And from that point of view also, taking a term cover to protect against that risk could be a good idea. And the QFA has to put these things into the perspective and then bring it into the conversation. Wherever required, the QFA can bring in the numbers also into the discussion and actually show that this could be your additional outflow and this is what can happen. There is a merit to taking loan cover, the insurance cover, and there is a merit to avoid that investment linked insurance in case of home loans.
But just to add to that, let's understand a situation where the client is forced to participate in a product while availing some other service. Let's say, for example, a locker service. If a client wants to open a locker service in a private or a PSU bank, and the banks force them that until and unless they participate in another product, let's say a lifetime FD or buying an investment product, they will not be issued a locker. Can a QFA play a role here in helping the client? If yes, how?
So I've twisted one particular story from Mahabharata for this kind of situations. The game of dice.
Yeah.
Right? Now, Duryodhan invited Yudhishthir to play the game of dice. And Yudhishthir went to play without consulting his advisor, was Bhagwan Krishna. So I put this into context and ask a lot of people, had Yudhishthir taken advice from Lord Krishna, what would be the advice? And most people say he would have asked him to don't go, don't play. But incidentally, the rules in that era were, if a king invites another king for anything, if you reject, that was like acceptance of defeat.
Yeah.
The second thing, a lot of people say, if that's the case, then beyond a point, in our language, said he would put a stop loss. So beyond this, you just get up and walk out.
Right.
That also was equivalent to accepting defeat, as per those times' rules. Then what would Lord Krishna have said? And the way I would love to put it, of course, this is not from the Mahabharata, as I said, I've twisted the story. Lord Krishna would have said, if Duryodhan is playing, you will sit and play. If somebody else is playing on behalf of Duryodhan, I'll sit and play on your behalf. Now let Shakuni play all the tricks. Right? And this is the QFA.
Right.
If somebody from the other side is acting like a Shakuni, then the Lord Krishna would come and say, okay, now play with me.
Right.
It's a really dual,
Apple to apple.
So, what a QFA can tell the client is, I understand, in order to avail a lot of services from the bank, you might have to oblige the banker by buying certain products from them. But certain products, and not necessarily all products that they offer.
Right.
Client would say, yes, wonderful. How would you decide when to say yes and when to say no?
Yeah.
Leave that to me. Bring that proposal to me, or take me along when this proposal is discussed.
Correct.
Together we'll take a decision. Okay, for locker, a fixed deposit is fine, a ULIP is not fine.
Right.
For a loan cover, a term insurance is fine, investment linked product is not fine.
Correct.
So the QFA can actually demonstrate that I care for you. There is no commission involved, there may not be a fee involved. I'm just there for you because I'm your well-wisher.
Right.
And I value the relationship that I have with you much more than the income that I earn.
Right.
I think that can really build that, that trust. It can strengthen that trust a lot.
Fair enough. So Amit bhai, let's say there's a situation where the client's priorities versus the QFA's approach for the client to prioritize is different, right? Of course, client's needs are the ultimate needs, but let's say the QFA would want the client to prioritize retirement, planning for the retirement, versus the client may come up with a more materialistic goal, which may be in the short term, or maybe not that materialistic, but let's say want to plan for their children's wedding, right? There's clearly difference in prioritizing which one can have the immediate attention versus which could be delayed. How can a QFA deal with such situations in a sensitive manner?
That can become tricky because each one of us individually have our views on certain matters.
Yeah.
And that's where when somebody analyzes the financial goals of their clients, they realize that much more amount was allocated towards wedding in comparison to education. Right? Now, somebody may have a view that how can you spend so much money on wedding and not spend so much on education? Somebody may say, hello, it's not your kids, it's their life.
Right.
I can't decide as a QFA what kind of a life my client should live.
Absolutely.
Having said that, if I see that the client is taking certain decisions which can have different repercussions in the future, I have to bring those repercussions in the discussion.
Yeah.
So if I tell that client that, okay, you want to do a lavish wedding, perfectly fine. You want to buy that luxury SUV, no problems. But please understand that some of the other goals may get compromised.
Right.
Will you be okay to drive, let's say a Ferrari today, and then travel by bus in the retirement years? I don't think you want that. What you really want is a good life now and a good life then.
Right.
So let's strike a balance between the two. Again, I'm not even suggesting that one should live a very, very miserly life so that you can have a lavish retirement. No, you need good quality now and good quality then.
Right.
And that discussion must be brought in. A lot of times the financial advisors make a mistake of dictating which goals are right and which are wrong.
Right. Right.
I think that can lead to friction between the QFA and the client.
Correct.
And in that process, while you may win the argument, you lose the client. And that also is not a good idea.
Absolutely.
So get into that conversation, showcase, demonstrate this is the possibility, but for that this is the cost.
Right.
Are you willing to pay the price? And most of the times clients see that sense and also would appreciate that the QFA has come prepared. The QFA understands about me and my life. I think that's what a QFA can do.
Very often there are situations, that the QFAs face with their clients where there are two options that a client could do. Let's say, for example, the client has received a sudden lump sum income. Should they use that income to invest and maybe reach or achieve a specific goal, a milestone in their life, or let's say pay off their debt and get debt free early? Let's say if that's the dilemma, or if there are such sensitive dilemmas. Of course, keeping the financial technical aspect aside, how can a QFA deal with such sensitive situations or such situations there's a dilemma and help the client go about it emotionally?
Now, once again, there are a lot of calculators available on the internet, and people do punch in the numbers, and they come out with some, I wouldn't say the answer, but they come out with something.
Right.
And in most cases, because the person entering the numbers is allowed to choose the respective numbers, I will put the loan cost as X and the return on investment as X plus something. When I do that, the interesting thing that happens is I am first of all earning something on the amount invested. But that amount invested at my balance sheet level, personal balance sheet level, is actually borrowed amount.
Yeah.
Because there's a loan outstanding. A lot of times people see these two in isolation. No, the loan is for home and this is an investment. Okay, but the moment you do a combined balance sheet of a person, then there's a leveraged balance sheet. The moment there is a leveraged balance sheet, the actual return on the capital gets enhanced.
Yeah.
So you feel good. But that enhancement in capital comes at a huge risk. Now let's look at those risks. And again, it's not a bad idea to have a loan outstanding and also have an investment portfolio. That's not a bad idea. But without putting other parameters which the calculator doesn't calculate. Take, for example, do you have enough liquidity? So if I put money in an equity portfolio, expecting equities to deliver more than the cost of loan, can I do short-term investment? No, I can't. I'll look at long-term portfolio. In the moment I look at a long-term portfolio, I am sacrificing my liquidity. But at the same time, if I don't invest and repay the loan, then again I am sacrificing the liquidity.
Yeah.
Right? So what do I do? Should I keep some money in liquid fund? Then obviously the carry is negative. So you have to consider the liquidity.
Right.
You also got to consider the carry,
Right.
how much carry you are comfortable with. The third thing is, while equity may offer more than the cost of the interest over a long period of time, the problem with this particular situation is EMIs have to be paid on a month-on-month basis.
Right.
Whereas equity, you are investing for 10 years, 15 years or whatever, long-term goals.
Correct.
How would you fund those EMIs if there is a possibility of loss of job or loss of income?
Yeah.
Is there provision for that in some form? Right? So if my job is reasonably stable, then I have the ability to take that risk of parking my excess liquidity for long term.
Right.
But if my job is vulnerable, highly vulnerable, then I don't have that ability. If I am the only earning member in the family, then my vulnerability becomes even bigger. But if there are 3 members in the family working, then at family level, we are reasonably sorted.
Yeah.
Now, when you put all these scenarios or consider all these aspects, only then a QFA would be able to see the whole picture and advise the client what to do and how to go about it.
Right.
The typical interest cover ratio that we talk about, which is how much is the income versus how much is the EMI outflow. How much is the liquidity available, and that liquidity or contingency fund that we keep talking about, now we'll have to also consider EMI for those many months.
Correct. Yeah.
Right? So when you do these calculations, only after that a QFA can be in a position to advise.
Right.
Not before that. So it's not a simple calculated answer that okay, 9% here, 12% here, हो गया काम. नहीं होता है.
Right.
I know a QFA who had 2 clients who had approached him around the same time, maybe with a gap of 10-15 days or so, exactly same question, and he advised exactly opposite in both the cases.
Wow.
Because the moment he evaluated the situation, the suitability was completely different.
Yeah.
And this is really where, an advisor has to analyze the numbers, analyze the qualitative aspects of the situation also.
Yeah.
Then comes the last point, which is where I have a loan out here and I'm putting money in a risky portfolio, with equity basically. And what if the market goes down?
Right.
Will the client be able to sleep at night peacefully?
Right.
Okay? Which is the willingness to take risk.
Correct.
So that appetite also must be evaluated.
Right.
And this is where all the situations become very tricky, that there are no right answers that can be applied to all situations.
Yeah.
An answer that is right for you could be totally wrong for me. QFAs can add immense amount of value in the life of their clients by simply looking at the client side, because nobody else looks at the client side. Everybody else looks at the product side, market side, taxation, etc., etc.
And that's the role a QFA plays.
Absolutely.
And that's the power the QFA has to bring impact in the client's life.
Absolutely. So eventually, that's the only thing that matters.
Yeah.
I mean, it's like a very simple thing. I wear a sweater in the winter, but when it is raining, I'll not wear the sweater.
Yeah.
It might be the best sweater in the world, but in this heat of Mumbai, in this April, May months, I can't wear the best sweater in the world.
Yeah.
And that's what the QFA brings in. Specific situation, specific likes and dislikes, risk-taking ability, cash flows, wealth levels.
Yeah.
All these things are considered together, and then the answer that is right for that particular client at that particular point in time is delivered.
True. So that was today's episode. We have Amit Bhai here casually dropping wisdom to all our fellow advisors. Thank you so much, Amit Bhai. I'm sure a lot of these situations that we're discussing in today's episodes, most of you watching this may have experienced it in some part of your professional lives. And I believe, and I would like to believe, that the insights shared today is going to help you going forward. Thank you so much for watching. Thank you so much, Amit Bhai, for sharing your insights and being a part of the show.
Thank you so
Thank you so much, and stay tuned for the next episode.